feel really good about what to look out for. Our first project in Washington State, our second hotel conversion project, I think we went 50% over budget. And our last project that we just delivered, we were 50,000 under budget. So a couple percent under budget. And we had budgeted for a 10% contingency above that. So it's pretty cool to see, just the level of execution that we're able to have.
Welcome, Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we are joined with Ryan Sudeck, CEO of Sage since 2023, leads finance, operations, and strategy to expand attainable housing while ensuring strong returns for the investors. Ryan, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure. Thanks for having me, Josh. Really appreciate it. As you mentioned, I'm Ryan Sudeck. I lead Sage Investment Group. I have the distinct privilege and honor of doing that. Our mission is to address the affordable housing crisis, and the way in which we do that is converting hotels to apartments. My background actually started in the corporate world. After growing up in New Jersey, moved out to California for college, met my wife there. Started my career in mergers and acquisitions. So instead of buying real estate and buying properties, I was helping companies buy other companies. A lot of parallels there. You got to have a strategy, a financial model, a plan, and you have to execute on the integration in the same way that we do with our real estate investing. Started investing in real estate outside my day job on the weekends. Started with a sixplex, then an eightplex, and a 16, a 30 unit. Eventually, when Sage Investment Group was formed in 2020, the company I now help lead, I took the properties that I owned and we actually did an UPREIT. So I contributed those properties into our fund that we now raise capital through. So it's been a fun ride. We've grown a lot. We're up to almost 3,000 units now, and really excited to talk more about our strategy.
Yeah, for sure. And you've got the experience of buying and merging companies plus real estate, and really buying a multifamily complex. That's just one of the same. It's an independent acting company on its own, and you've got existing staff on site most of the time, and then you've got to optimize the business. Tell us about your first deal. Let's get into real estate first. Tell us about your first deal, how you found it, how you got into it, and all the good stuff, the learning lessons.
Yeah, the first deal I did personally is I bought a sixplex in Tacoma, Washington. So I'm at Sage's headquarters, which is in Kirkland, Washington, just outside of Seattle. Tacoma is a city just south of Seattle. And first property I bought was this sixplex. It had fallen on hard times. It had a ton of foundation issues. I found it actually on market. And we ended up, I actually worked with my now partner, Ross Hubbard, who founded Sage. He helped broker the deal for me and get me set up with the contractors, but we were able to get it for 10% less than the list price at the time. This was probably 2015, about 10 years ago when we did that. And it did have a bunch of foundation issues, had some structural repairs that needed to happen, but walked through with Ross, walked through with the contractor, and it was just a matter of scoping out the construction plan, the budget, and it was something we could do. So it was a fantastic result. Ended up leasing out, doing the renovation, leasing out the 6 units. We bought it for $400, put $125,000 into the renovation, and it appraised for $925,000 when we were done. So I was able to pull out all of my capital and bought an eightplex with that capital and just started that. It's kind of the Burr method. I don't even know if people were referring to it as the Burr method at the time, but kind of started that snowball effect, and that kind of helped kickstart things.
Must have been in a incredible area for a sixplex to get a little under $1 million.
Yeah, I mean, man, real estate's run up dramatically, as we all know. And, it's why Sage exists, and our mission is to help address that affordable housing crisis. But yeah, at the time, I can't even remember what the rents were. It wasn't in the best of areas. I did get some halo benefits of the city investing a ton of money in that district to help revitalize it, making it a little bit more walkable, putting in sidewalks, outdoor concert amphitheater. So certainly, buying in the right location is obviously extremely important, as is getting the right cost basis on the purchase. I think most folks were just scared off by, some of the structural and foundational issues that the property had.
Yeah, I think cost basis is truly everything. If you don't buy it right, you're going to be chasing it all the way down to the end. It doesn't matter what you do on renovations. If you
Totally.
essentially sell your equity on your own purchase price, then you're just chasing your tail.
You make your money when you buy. That's
Yeah.
definitely part of our ethos here at Sage. It takes us, upwards of 2 years, sometimes 3 to
Yep.
4 years from when we start talking to a seller on an off-market property to when we transact, because we know what we're willing to pay and we're not willing to compromise on that.
Yeah, and then you reach perform on your second lease, not your first lease, especially if you've got a heavy lift. It's just the way it goes. Doesn't matter how hard you push your renovations timeline, you still have nonsense you have to force your new tenants to deal with while you're renovating and all the fun stuff.
Yeah, that's the
That's
beauty of our model today is that we have fully vacant properties while we do all of this
okay.
conversion work. So we usually don't have that noise and dust issue, but certainly with value add projects, which is what we used to do. You got to kind of manage the tenant experience for everyone else, right?
Yeah, let's talk about that too. So you're converting hotels into multifamily. So how do you? I know that there's affordable housing crisis going on, which I don't think there's a housing shortage. I think there's an affordable housing shortage. So we're 100% in alignment with affordable housing. How do you start getting into hotel conversion and finding that attainable?
Yeah, it started in 2019. That was the first hotel conversion project that we did. It was in Tucson, Arizona. The property was a 175 room hotel. Half of it had already been converted. So the business plan was kind of laid out for us. Convert the second half. Our ideal target demographic was students. So this was right down the street from the University of Arizona in Tucson. We bought it in 2019. After renovation, we delivered in 2020. In the middle of COVID, there were no students on campus. And so we had to pivot our marketing strategy. So pivoted to just general workforce marketing, appealing to a couple core demographics of tenants, and it leased up like that. So it's a bit of the light bulb inspirational moment for us to get into hotel conversions. And now we just started our 25th project on last Friday.
So are you tearing down walls in these hotels to make the rooms bigger? How does that, what's the business plan look like?
Typically not. Typically, we're just taking the hotel rooms as they're given to us and converting those into the apartments. So sometimes we'll have, 1 bedrooms and 2 bedroom suites in these hotels, but more commonly, these are studios and we're leaving them as studios. They're, efficiency hotel rooms. We leave them that way. We add full kitchens so they function as an apartment. We take all the hotel amenities, we repurpose those. We don't need conference space necessarily in an apartment building, but a fitness center and co-working space, we certainly do. The math doesn't usually check out for us to combine units, because typically, if you take 2 hotel units, combine them, you get a 1 bedroom apartment. The studio rent is usually, not 50% of a 1 bedroom rent, right? You can't double the rent when you combine 2 units. So typically to maximize our return, we're keeping, the units as they are. The exception to that would be if there was a larger property, which we haven't taken on yet, but if we had a property with more than 200 units, let's say, and we were worried about oversaturating the market with one type of unit, then we would look to combine. We'd obviously reduce the amount we'd be willing to pay for the property to the seller. But we're typically staying between 100 and 200 units to kind of get that scale on the lower end of on-site property management, economies of scale on our construction costs, but then not going above 200 because we want to control that saturation risk and make sure the market can absorb and lease up the properties quick, which has been our experience.
So how do you go in and say we want to get rid of the hotel feeling here? So what would be your game plan to get rid of the hotel feel?
There's a lot of different things. It depends. So a lot of the construction work that we do on the infrastructure side is driven by the city code requirements, because we're taking something that's functioning as a commercial asset and converting it into residential use. So fire suppression, life safety are important. So if there's not sprinkler systems in the building, usually we're adding sprinklers. If there's not electrical sub panels, we're adding in each unit, we're adding those electrical sub panels. So after that infrastructure work is done, then it's a total remodel. These live like a brand new property when we're done with them. So adding kitchens, typically a full-size kitchen with a range, cooktop, refrigerator, microwave, nice counter space, cabinets around that. Redoing the floors, paint, casework, new doors, windows, new roof sometimes if needed, the outside envelope of the building, we're renovating as well. And then, like I mentioned earlier, repurposing those amenities so they look and feel new. And you really can shake off that hotel feeling when you take that big empty ballroom and put in fitness equipment or some other amenities. Generally speaking, we like exterior corridor hotels where you enter your apartment from the outside. That gives our tenants a little bit more feeling of that independence, having their own space. You also don't smell each other's cooking as much, and it helps on the efficiency of renovations too.
Yeah. So you all sub meter out each unit, or is it still master metered?
Typically master metered.
Okay.
I think there's only one property where we've got sub metered, but we're typically doing a utility bill back master
Okay.
meter.
Yeah. That's it would be extremely cost prohibitive to go in, and I mean you'd have to rewire it. I mean that'd be huge.
Yeah.
That'd be okay. Cool. I asked this because we're in the middle of I've got a 144 unit extended stay that we're converting over, so I'm
Cool.
very familiar with the landscape. And I mean it's 18 buildings, 8 units per building, so it's got the feeling of an apartment community, but it was just different operations. So and it does present affordable housing in a sense.
What market is that in?
Cincinnati, Ohio.
Cincinnati, Ohio. Okay.
Yeah. So it's but same hotel operation conversion into to multifamily. So it's working out. What has been some learning lessons that you've learned so far getting into this market that you wish you knew then, but you now know?
There have been many. I think understanding how to navigate the local jurisdictions, because as I mentioned earlier, we're taking something that's functioning as a commercial asset and changing its use to residential. And that requires getting a change of use permit, making sure that we have the proper zoning to allow for that. And now we have a fantastic team headed up by our head of community relations, Whitney Wilkins, and our head of planning, Jeff Farrell, who are they're talking to the city council, they're talking to the mayor, they're talking to the planning and permitting department before we even buy the property, before we even usually get under contract on the property, to understand what requirements we're going to be held to. In early projects, we got bit by energy code. That was an early one where there were a certain amount of energy code credits that we needed to obtain. We had to put these HRV regulating units in there, add new windows where we weren't budgeting for that. But it's been great to roll a lot of those learnings forward, and it just de-risks things. We don't buy properties, generally speaking, with any entitlement risk. We're trying to sort out those entitlement risks prior to close. We actually have that as a contingency in our contracts. Sometimes we've chosen to take that on if there was a clear path to getting entitlement sorted. That's been one, I think, area of risk, is just the entitlement and understanding what requirements we're going to be held to by the city, because there isn't a code book that says, all right, here's what to do when there's a hotel conversion in your jurisdiction. They're trying to take the residential code book and apply it to ours, sometimes the new construction playbook. And so some cities, there's a city in Colorado, I won't call them out, but they wanted to charge impact fees. The same amount of fee for each one of our studio units that they were charging for if we had built a 10,000 square foot luxury home is the same amount of impact fees. And so they're ultimately trying to do their job at the cities, and I empathize with that. This is just an alternative way of developing. We're taking an existing asset, redeveloping it in a sustainable way. And sometimes the code is a little bit more rigid to allow for that. But our team's really good at navigating that process. I think there are other learnings that we've had on the construction side, making sure that we're getting triple bids, selecting the right contractor. Certainly we've hired a great team on the construction management side to help run that process. Also on the asset management side, finding the right property manager who understands our tenant type and can manage that lease up well. That's another huge area of focus.
What is your tenant demographic looking? I know your market rate. Are you also subsidy?
No, we don't. We're not permitted to exclude that, but we don't pursue it. And so we are market rate, as you mentioned. There are 3 core demographics that we appeal to. One, young professionals. These are folks that were living with their parents or their family, maybe had roommates before, now want some independence, living on their own. Second core demographic is that middle-aged, sometimes single, sometimes a couple usually with a pet, it's a dog or a cat. And they're the folks that are making too much that they don't qualify for any government subsidy, but not enough to afford the Class A luxury units that are down the street that are usually $300 to $500 more than our units. And then the third core demographic for us is later in life, fixed income, 55 plus, usually a couple again, usually with a dog or a cat. They don't need a lot of space. They're aging in place. They don't need any of that, additional care to help them live, but want to live in a new, place that feels new and is affordable for them.
Yeah, all bills paid. They just show up and it's ready to roll.
That's right. Yeah, these properties are usually cutting down our tenants' commute too, which is usually their second largest expense. The hotels are really well located in commercial cores, near transit, near restaurants, near hospitals where our tenants work.
Yeah, and usually if you take one of those offline, then it boosts all the other properties surrounding to help lift all the other boats, get out of their lane, and now you're swimming in a different lane. So it helps out all the other businesses. Cool. What so you find a property, you put it under contract, you get make sure that you can operate within zoning changes, make sure it's something that the city even would allow, and then you're going through each unit, build a capex budget, and finding out cost, seeing if it's viable.
That's right. I mean, even very early on, we're doing Matterport scans, 3D visual scans of the properties. We're trying to get as-built, plans put together so that we can start figuring out the budget. And so that happens really early on. We go through at least 3 versions before of the construction budget based on the stages that we go through in our diligence process. We do pretty invasive diligence. We fly the same inspector out to each one of the properties that we're looking at all across the country because they've learned over the years what we look for. We're doing thermal scanning, sewer scopes, those things, but also cutting open walls, getting behind the drywall to look at the drain stacks, the supply lines, understanding where the utilities are, understanding what conditions they're in. We'll put those walls back if we don't buy the property and return it to its condition. But we're going pretty deep to understand what's there so that we can refine that budget.
Yeah, and you almost have to, because what you don't know, you're going to find out, and then it's just doesn't fall within the 10% variance.
That's right.
Hopefully it does. So
Yeah,
very cool.
learned a lot. Now, feel really good about what to look out for. Our first project in Washington State, our second hotel conversion project, I think we went 50% over budget. And our last project that we just delivered, we were 50,000 under budget. So a couple percent under budget. And we had budgeted for a 10% contingency above that. So it's pretty cool to see, just the level of execution that we're able to have.
What kind of, so you're putting in full kitchens. I know full kitchens, you're putting in the new amenity package, such as a gym. These properties probably have pools, of course, getting that revived. What are you doing with the check-in, check-out area, the front desk?
It just becomes a leasing office usually.
Okay.
So staffed by on-site property management. And then some hotels will have a bit of a bigger check-in area, and so we'll make it a lounge. Maybe add some pool tables, couches, TVs, kind of a hangout space that's next to the leasing office.
Very cool. And a lot of these properties, they're down the road from college areas too. So you've got you can help that area as well. I know UC here is fully. There's not a property around the school at all, so it's all off now. It's off campus housing, which again, it just helps out all the other businesses too. So
totally.
Very cool. How do you treat your investors? Tell us a little bit about that front, where you're sourcing capital, and then what that whole picture looks like.
Yeah, it started with our own personal balance sheets. So I've got 2 partners, Ross and Emily. They started Sage back in 2020. As you mentioned at the beginning, I joined about 2 years ago, although I've been an investor since the beginning. And they're our largest LPs. I'm right up there with them. And so our incentives are very aligned with our investors, our LPs. So it started with friends and family, word of mouth, grew from there. We used to be a 506B offering. Now we're a 506C offering. We're not really marketing a whole lot, but the natural organic networking that's taken place, we've benefited from a lot of great press about the impact we've had on communities. And so folks are finding out about us and then investing with us. We really appeal to high net worth investors that are looking for an investment opportunity that's compelling both for its return potential on the equity upside, also its income potential, the diversification, because we're structured as an evergreen fund. So all investors in Sage own the portfolio in Sage. So you're going to own a piece of 3,000 units across the country, even though your investment coming in is going to help us purchase the next acquisition. So we keep a high bar on the return profile that we're looking for. We identify deals that we like. Right now, we've got 7 or 8 that are slated to close in the next 6 months. And once we have the property identified, we go out and we raise the capital for that. We're not sitting on a pile of money trying to deploy it out. Again, because this is our primary wealth generation tool as partners. We want to keep a high bar there.
Yeah, it just dilutes all the other returns when you're sitting on capital waiting to deploy, for sure. Cool. How are you all using AI? I know everyone's touched AI. They've dabbled with it, but if you dig deep, you can really use it and optimize operations.
There are a few ways. I certainly use it in my personal workflows every day. ChatGPT is open on my desktop all the time. One of my favorite applications is Superhuman for email.
Yeah.
It does a lot of auto drafting. That is a really powerful tool. On the real estate specific front, we're using a tool called OpenSpace.ai. And so I described earlier how we take 3D videos of properties when we're going through them. We walk through every unit, and OpenSpace allows us to take that 3D image and overlay it on our plan set. So this is super helpful as we're trying to build out our scope of work, understanding what the construction is going to cost. But then it's really helpful for us to keep rescanning the property as we go through construction. So you can imagine as we pull back the walls, you see where utilities are running. Maybe later on you want to make a modification and you've covered the wall, and you can go back in time and say, all right, here's where that utility stack is. We can also hold our contractors accountable in that way on progress. Eventually that tool helps us do punch outs at the end, where we can note on the image in each specific unit, hey, here are all the things that need to be fixed. So it gets us out of that, kind of paper trail mess and streamlines operations. And our contractors, our construction managers, the whole team can be operating in one system to understand the progress, what's required to get it to the finish. It's also nice for investors too. They love seeing the progress photos.
Oh, for sure. And it eliminates a ton of brain damage in the middle, just going back and forth. And I know that there is an app that's being built to where you basically just videotape or video record the unit. It automatically creates a punch out list for the units. So it's interesting to see some of these things that are going to be surfacing that are going to save a ton of time. I don't think there's a saying, AI will not take your job, but it will replace you with someone who is using AI.
Yeah.
So
I have a bit of a different take depending on the profession you're in, but I think generally speaking, real estate, what you said holds true, that you can just get more powerful. But I think I'm not an AI expert, but I see the layoff news in the tech world and talk to CTOs of companies and how much code's being written by AI, or layoffs of lawyers. I think there's a big threat on knowledge workers with AI, and you got robotics on the other end of the spectrum too. So it's an interesting time. It's dynamic. So
there's certainly going to be displacement for sure. I mean, P&G announced, Kroger's announced layoffs. I mean, they call it optimization, which it is in a sense, but there's going to be displacement. I think that regardless, people that are using AI, that are becoming operators, that are able to skill up, will become valuable to another company, because ultimately someone's going to sit back and have to still manage pieces that are managed by AI. So it's just becoming.
And how cool is it that we've lowered the barrier of entry to start a company too, for those folks who want to pursue entrepreneurship? Like that's incredibly.
You can now become be a vibe coder and build it and build your app. That's right. It is cool. I mean, it does open up the doors for a lot of people who couldn't do something before, and now there's really no excuse. It's just use your time the way you use your time. But if it's in the right area, then you can make something of it and make it big.
Yeah, it'd be interesting to see what the future holds. I mean, certainly, certainly the affordability crisis is not getting easier
Yeah.
for folks when it comes to housing. And I agree with what you shared earlier, just that we don't have necessarily a supply issue. It's just the type of supply, right?
When I say that, because we've got vacancies in our portfolio that are just, I mean, it doesn't feel like stagnant. They'll lease up, but if it was a supply issue, there would be a waiting list for units regardless. And there's just not in Cincinnati. I mean, you go online, you can find apartments, you can find housing. Is it affordable? That's the big thing. Are there people willing to pay the price? And that's what we're not seeing is people willing or capable of paying the price. So I think there's going to be other forms like UBI kicking in to help offset the cost on a more broader level. But I mean, there's definitely an issue there for sure.
Yeah, and I think we might be playing in a different swath of the market because what we've found is, we're a few $100s less per month than the next cheapest apartment. We're higher quality, arguably higher quality because we're new, fully renovated, and we lease up pretty quick. There was just 2 days ago, we were meeting with the asset management team. And we have a property that hasn't even been delivered yet that we're already raising rents for pre-leasing. It's a construction site right now. And that's because, it's $300 less per month than the other studios and it's in a good market. Our lease ups are measured in weeks and months, not years. We usually budget for about 6 months. Of our last 6 projects, 5 of them have been under that 6-month mark. And 5 of the last 6 have leased out for more than our underwritten rents, just at that segment of the market.
So you just said it, you're $300 less than comparable studios.
That's
So how are you're all, well, that could be a loss leader getting things leased up, or is it a strategy play to stay at that price basis and keep it leased up?
I think there's the difference. The way I'd articulate the difference is that there's what we underwrite to, which is having that gap because we want to have certainty that we're going to fill up the property. Then there's how we execute the business plan. We are market rate. We're not, we're trying to maximize our return on behalf of our investors, but we want to be conservative in our underwriting and then raise as we go, which is a common theme as we go through the lease up.
Yeah.
Sometimes we do have loss leaders and concessions, but it's kind of different than just saying, hey, we're going to stay at, these low rents. It's more that try to be conservative on the underwriting, ensure we can get it full, get to that 95+% economic occupancy, and still have strong demand.
Yeah, that's smart. That's good play for sure. Are you all operating the properties as well, or are you third party?
Third party property management. We're spread out across 6 states right now and 29 properties. So, and we just try to find the best operators for each one of them.
Yeah.
And usually it's a scaled regional player that might have 20 to 30,000 units in their portfolio. But we've worked with one of the top 10 largest property managers in Texas on our Texas properties specifically. And then we have an in-house asset management team that's picking the right PM, holding them to the budget, managing price, helping inform pricing and other decisions that need to be made along the way.
Very cool. Are there plans down the road to roll operations in under the hood?
No, I have a lot of respect and appreciation for the property management world. It is a low margin, thankless business, generally speaking. If you're in it, that's my opinion. I certainly appreciate the folks that are in it. But we feel like where we really add value is on the development side. That's where we can add value for our investors. Being able to value engineer, for example, our electrical scope to rewire and put in a new panel is, a third of what it would be market rate because we've been able to,
economy of scale.
Yeah, get scale, but also know what labor to use for the right job.
Yeah.
You don't need a master electrician to pull out old wires. You sure as heck need that master electrician to plug them back in, though.
Yeah, pull permits and all good fun stuff.
Exactly.
Awesome. Is there anything that I'm not asking you that we need to let the listeners know? We should let them know?
I think the most important thing for listeners to understand about why hotel conversions are so compelling is the fundamental disconnect between how a hotel is valued and what an apartment's valued at. If you know what a cap rate is, think of a 12 cap for a hotel going to a 6 or 7 cap for an apartment building.
Mm-hmm.
If it's easier to think in terms of revenue multiples, think about 3 to 4 times revenue multiple for the value of a hotel versus a 7 to 12 times multiple for an apartment building. And that's really powerful. There is a lot of complexity that, is embedded in this arbitrage, so to say. And you need to execute well on it. And we've got a team of 30 now to be able to do that. But if you can change the use, if you can convert it to this highest and best use, for us, we underwrite to at least a 40% increase over our cost basis in the value once we stabilize it to multifamily. So it's just incredibly powerful from an investment perspective. And I think for us, we came from the value add multifamily world. I haven't seen a value add multifamily deal that meets my return expectations in at least 4 years, 3 years,
and
maybe even longer than
not
that,
coming
maybe like
back.
5 years now at this point. And so if I think this strategy is quite compelling just because the return potential and then having that demand on the backside that's pretty insatiable for the tenants that are looking for something that's naturally affordable.
Yeah, I agree. Cool. Very cool. Ryan, if somebody wants to get a hold of you to learn more about investing with you guys, learn more about your business plan, learn more about you, how can they get a hold of you and reach out?
Yeah, you can go to our website, sageinvestment.com. Please don't hesitate to reach out to me on LinkedIn. You can find me. I think I'm the only Ryan Sudeck out there, but you should be able to find me. Feel free to shoot me a LinkedIn message or reach out via our website.
Awesome. All right, Ryan, appreciate your time. Thank you.
Thanks so much, Josh.
All right, bye.